Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. Remember, this video is for informational purposes only and should not be relied upon to make any sort of investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed on today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is, here we go, another week in the markets, and this week saw the markets pop about midweek when we got really good inflation data on Wednesday, and then they started to trend down for the rest of the day on Wednesday, and actually the Dow ended up being negative that day, and essentially that theme played out for the rest of the week as well for the rest of the markets. Much of the downdraft in the markets on Friday was attributed to a report that the University of Michigan puts out called the Consumer Sentiment Index. Now, those of you that are in Ohio, those of our clients in Ohio, this isn't a bad report just because it comes from the University of Michigan, okay? You can't just, lump all bad apples together. This report tracks consumer sentiment in the U.S. based on surveys, and those are random samples of U.S. households. This report aids the government and economic community in gauging how optimistic or how pessimistic households are feeling about things like their personal finances, the business conditions in the U.S., and a host of other topics. The index fell 9.3% from last month, which is interesting considering how inflation has come down and our employment rate hit a new record low, at least a record low since the 1950s. Yet this report was still very negative, about 9% more negative than last month. It was also down about 1.2% from a year earlier, so down on both fronts. The rating came in at 57.7. Now, to put that in perspective in recent history, the reading was as high as 101 in February of 2020, right before the pandemic hit the world. Our weekly claims for unemployment insurance, another thing we track each week, that hit a one-year high this week, as you can see on your screen, with 264,000 new claims for unemployment insurance being filed for the week. That's certainly something we'll continue to monitor every single week going forward, as we have been. This was the highest number we've seen since November of 2021 when we hit 265,000, and around that time frame and basically most of 2021 we were anywhere between starting the year around 800,000 unemployment claims each week and trended down to that 265 by the end of the year, November, as I just said. And then they've continued to hold steady there, even be much lower than that. So that's important data, something that we're going to watch as a leading indicator. Finally, the S&P 500, which is our proxy for growth and growth in income stocks, but only when taken together, was negative 0.29% this week. The Russell 2000, which tracks our more aggressive growth, smaller companies in our Dave Ramsey vernacular, that was down 0.99%. And finally, the MSCI EFA, which tracks international stocks, that was down an even and full 1%, 1.00 this week. And point number 2. The U.S. Consumer Price Index, that was released this week. That's the inflation rate, basically. The fancy term for the inflation rate, the CPI, Consumer Price Index. We got our reading for inflation for the month of April, and the numbers continue to drift lower, albeit slower, than we'd probably all want it to be. The CPI numbers came in at 4.9%, and this was slightly lower than last month's report, as you're seeing on your screen here. And notice the peak which we hit in June of last year, was 9.1%. That's when those I-bonds were so popular because inflation was so high. The largest component keeping inflation higher in April was housing costs. So if you've been in the home purchase or rental market lately, you're able to 100% say amen to that because you've seen that prices still remain elevated there. Things that helped drop the inflation rate this last month were transportation and medical services. So a few of our service industries are keeping that number in check a bit here. But the key here is keeping inflation directionally going the right way is very helpful. And the reason it's very helpful is because it gives the Fed the ammo it needs to keep interest rates steady and maybe even potentially drop them at some point, but at least steady. At this month's Fed meeting in May here, President Jerome Powell indicated that they would likely be done raising rates, but are always data dependent, meaning that if CPI came in too hot or any other economic data came in too hot, we might see rates head higher yet again. This week, we also got the producer price index, and that came out on Thursday of this week. And that number continued its climb down, coming in at 2.3%. Now, that was down from 2.7% in March. And this is actually the lowest rate for the producer price index since January of 2021. Now, remember, the PPI number is important because it tracks what producers get paid for their output. And if producers are getting paid more, it will work its way ultimately towards consumers. So this is good to see that this number is continuing to go the right way, continue to fall. It's another arrow in the quiver of the Fed's quiver of saying, hey, we want to try to keep rates neutral and maybe even drop them at some point. And point number 3, you guys really watch this kind of stuff? That was my first thought when reviewing this U.S. gasoline demand, which is courtesy of the Energy Information Agency. But yes, we look at this kind of stuff because it's all important, especially gasoline demand, because it impacts so many areas of our economy, whether it's just you and I driving, taking our vacations, getting products to us. Now take a look at this chart that you're seeing on your screen. The brown line shows you the 4-week average of daily U.S. gasoline demand from 2021 through 2023. The blue line is just this last year, 2022 and 2023. And what you see is that the last 7 weeks, year-over-year comps have actually turned positive. We're spending more money on gasoline. We're using it more, I should say. That is because starting around February of this year, we started paying lower prices for gasoline than they were a year earlier. Lower gasoline prices, even amongst other pessimistic signs in the economy, will drive positive economic activity. So while we Americans are facing a lot of inflationary pressures in other areas of our lives, it's good to see that gasoline prices are going the right way directionally. They can help me personally in my argument against a recession. At least, of course, that's my opinion right now, is that I just don't see a recession with high employment data, and this gasoline stuff also helps. Point number 4, $16 billion. That's obviously a lot of money, but that is the total cost to the FDIC for their losses in the failures of Silicon Valley Bank and First Republic Bank. To add insult to injury to the state of California, PacWest Bank, another California-based bank, actually they're based in Hollywood, is on the brink of failure. Maybe this next week or the week after, we'll see that. And guess who pays for that? Your initial guess is probably you and I, right? And you would technically be right, but not actually, and probably not in the way that you think, because you're probably thinking tax dollars is how we pay it, like a lot of things with the government. Well, the FDIC is not funded with tax dollars. It's actually funded with fees to the banks under their banks that are under their insurance. A new special assessment fee is going to be charged to about 113 of the U.S. largest banks, and this fee will be levied upon uninsured deposits that banks hold in excess of $5 billion. That was really what kept hurting these California banks, was all this money in the bank's deposit rolls that were not insured because they were over the FDIC limits, thus creating very quick runs on the bank, people pulling that uninsured money out. The fee would be collected over the next 8 quarters, so 2 years, starting next June, and could be adjusted depending on what problems the state of California puts on our backs. Facetious there, but it is California. Now, by the way, at the end of last year, the FDIC fund stood at $128 billion. So this $16 billion is a lot of money, but it's a small percent of the money actually held in the FDIC fund. So back to my original question, how do you and I pay for this indirectly? Well, look at your bank's interest rate on your savings. It's pretty awful. And it's probably still pretty awful. All the while, things like the Schwab money market are able to pay you 4.8 and trending higher recently. This is how you end up paying for those sort of fees. Not getting a market rate on your savings at the time that interest rates have actually spiked is a tried and true way to charge you without charging you. And most Americans won't complain or won't do much about it. It's the entire reason why the Wall Street Journal wrote an article a few weeks ago, maybe a month ago, called the $2 billion question, or maybe it was the $40 billion question, I forget. But the point was, they looked at all the money that was getting below average market returns on their savings versus if they would just put that money in a account that was getting a decent rate, and it was billions of dollars in lost interest. So ultimately, all that to say that is how you end up paying for those FDIC fees that will now be levied against banks starting in next year to pay for the 2 California banks that we just got taken over. And again, continue to watch this report because we will put out if any other banks get taken over. So thanks so much for watching the 4 things we learned in the markets this week. If you enjoyed the 4 things we learned in the markets this week, would you do us a favor? You can do us a favor by hitting the like button on the YouTube page. The like button helps us with YouTube and Google's algorithms get our content out to more people, as well as hitting the subscribe button so that as we put content out, that content can be pushed to you before anybody else. As well as if you would like to schedule a meeting with any of the financial coaches on our team, and the financial coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live on a budget, and hold you accountable to that, you can click that link to schedule a meeting with them. You'll also be given the opportunity to schedule a meeting with any of our financial planners, and those folks will help you get through baby steps 4, 5, and 6, start retirement, start your kids' college, and also help you build out a plan, retirement plan, financial plan, and otherwise to get your house paid off, to do all the things that you should want to do in your Dave Ramsey and Ramsey Solutions journey, so that ultimately you can get to baby step 7 where you can live and give like no one else. Thanks so much for watching this week's video. We'll look forward to seeing you next week.